Welcome to Who Knows Real Estate, Episode 6, Launching into Multifamily Real Estate. I'm Kevin.
And I'm Jim. And today our guest, Jonathan Twombly, the principal of Two Bridges Asset Management, goes into his story of growing a multifamily portfolio of 400 units. And he covers everything you need to know in breaking into multifamily, such as common mistakes to avoid, when underwriting, how to build relationships with brokers the right way, unique value adds, and how to finance deals. This is a great episode if you're interested in getting into multifamily apartments. Here it is. So today we have Jonathan Twombly, who's the principal of Two Bridges Asset Manager. He also is the founder of Multifamily Launchpad and has his own real estate podcast. Jonathan, how's it going today?
It's great. Thanks for having me on your show.
Yeah, absolutely. We're really excited. Would you mind giving our listeners just a couple of minute background on yourself?
I'll try to keep this as short as possible. I was a lawyer on Wall Street for 12 years altogether. Was really unhappy doing that. Had always been interested in real estate and just had some timing work out well for me where I actually lost my job after the great financial crisis. And I just right around that time happened to meet somebody who was starting a multifamily investment business who asked me if I'd join up with her. In talking with friends about whether I should do this, a number of friends said, hey, if you do it, I'll invest money with you. So a bunch of stuff sort of came together at once. And that was how I initially broke into the business. So, now I'm focused on investing in, 100, 125 unit complexes in the Southeast, and actually recently sold everything that we owned. So I'm kind of going for round two soon. But we recently went full cycle and exited everything. So it's been interesting.
Wow, that's impressive. And what did you get to before you sold the whole portfolio of communities?
So we had 404 units altogether by the time we got an offer that enticed us to sell.
Okay, nice. And what kind of made you decide to sell in today's market versus holding on? I mean, obviously it's a hot market, but what made you decide to sell it?
Yeah, I mean, just the pricing that we were offered was extremely attractive. And my view of the market is that the risk now is to the downside, not to the upside. There's a lot more risk of, losing out on a payday than there is on losing out on upside from not selling, or from buying at the right now. So I thought it made sense to sell, get my investors a nice return while I could grab it, and it was good for the business to establish a track record to actually go through a full cycle. So there was a lot of things that kind of made it sense.
Yeah, I like that approach. I mean, call it conservative or analytical. It's a good approach to, sell when you feel it's the right time in the cycle. I'm assuming you've probably got that kind of mentality when you're purchasing an asset, as far as a conservative approach to, hey, this is a cash flowing asset, or it can be a cash flowing asset without too much speculation involved.
Yeah, I mean, my approach, I like to approach things conservatively from a couple of different angles. Like, one is obviously, as you mentioned, sort of on the underwriting angle of things, where you're looking in trying to build in some kind of margin of safety into the purchase, right? And where you're getting something that you believe is below its intrinsic value, right? That gets harder and harder as you go through the cycle. So the second part of being conservative about it is when you're buying, right? It's, you can kind of approach things conservatively at the top of the cycle and then have the cycle work against you. So even though you do everything right, you can still get slammed, right? Or you can operate conservatively at an earlier point in the cycle and have the wind at your back, right? So the further you go up the cycle, the more and more conservative you need to be. And for most investors and most people who are in the markets, it tends to be the opposite. Like the further they go up the cycle, the more aggressive they become, because they have to be to kind of make the numbers work. And making the numbers work is always problematic, right? So they think they're being conservative, but they're not. So you have to get, you can be more aggressive early on in the cycle when people are scared and there's a lot of blood in the streets and nobody wants to buy. But as the market gets hotter and hotter and hotter, you have to go the opposite direction of the market and get more and more conservative yourself.
Yeah, that's completely right. Do you have any things that you see investors commonly exaggerate when they're looking at deals? And this type of market cycle we're in, where they want to believe like, rent is going to increase at 4% a year for the next 8 years. Are there any common things you see that they're a little aggressive on?
So what I think a lot of people make the mistake of, there's a few common mistakes that people make. So one is assuming that the current great environment is going to continue for the entire time they hold the property and pay for that great underlying performance. So right now unemployment is like the lowest it's been since 1969. People are paying for that. They're assuming that's going to go forward for the next 5 or 10 years as long as they hold their deal. Ironically enough, I don't know if you guys know this, so they keep on saying, lowest unemployment since 1969. The month after that low point was recorded in 1969, the country went into a recession, right? So so I mean, like the low point of unemployment is the peak of the cycle.
Right.
It's when unemployment starts. But the same thing with rent growth. Like people say they're underwriting with the crazy rent growth that we've had for the last few years as if it's going to continue. And like history shows that we have cycles where there's really strong rent growth and then there's weak rent growth, and usually one follows the other. So you can't make that assumption. So that's one assumption I see people making. Another assumption I see people making a lot, which is a mistake, is on their exit cap rates, right? When they're trying to figure out what this deal is worth over time, you have to figure out some sale price, right? And the way that you do that is you project your net operating income growth over time, and then you apply a cap rate to it. And what people are taught when they're taught underwriting is that for whatever cap rate you go in at, so you buy at an 8 cap, for every year that you hold it, you add 10 basis points to that cap rate for your exit cap rate to account for the aging of the property, right? So that's standard kind of conservative, underwriting. So if you exit after 5 years, you'd exit at an 8.5 cap. If you exit after 10 years, you're looking at a 9 cap, because the fact of the matter is you don't know what cap rate you're going to exit at because you don't know where the market's going to be at that point, but you make it more conservative. What I see people doing a lot is they're buying at the top of the market and cap rates are compressed. So maybe they're buying an asset that normally would trade at an 8 cap for a 6 cap, right? And then on their exit, they're saying, I'm being conservative. I'm going to exit in 5 years at a 6.5 cap. That's really unrealistic. They should be doing that exit cap at an 8 because given that you don't know what the future holds, you don't know where we're going to be in 5 years, anything could happen in the next 5 years. Like if you ask people in 2007, where would it be in 2012? They would have said, the Dow would be at 40,000 and, we would all be driving electric Lexuses that fly. I mean, so it's like, you don't know where you're going to be in 5 years. So what you should assume is that you're at the long-term average of whatever it is that you're buying. So if the long-term average of that asset is an 8, you should be exiting at an 8. And what you'll see if you take a lot of deals that you see people doing and you take their exit cap rate and you stick an 8 on it instead just to see how it works out, they're losing money. I mean, it's not only are they not performing as well as they thought, like if they had to sell under those conditions or had to refinance under those conditions, they would actually be impairing investor capital. So that's another thing that I see a lot of people doing, but they're doing these things because otherwise the deals don't work, and everybody's complicit in this. The banks are complicit, like everybody's complicit. I don't know if people are consciously lying to themselves or if they're all unconsciously lying to each other or what it is, but you're just seeing a lot of this at this point in the cycle.
Yeah, that's interesting. I'm curious what are you focusing on now? If you think that the market is probably towards the peak, like what are you focusing on? Are you still looking for multifamily deals or are you sitting on the sidelines?
So I am looking for very specific situations.
Okay.
Right. So for instance, I have clients who have really particular needs that may be driven by a special tax situation or something where they understand where we are in the market and they're willing to go in sort of very conservatively. They're not looking to hit a home run. They don't need to make a 20 IRR. They're realistic about things. They're looking to solve another problem. Looking for situations that work for things like that. But also really what I'm doing is preparing myself for the next stage, right? So we know that what goes up must come down. It's going to come down at some point, probably. I think we're going to get some reality in the next couple of years. So, if you wait until that point, to start the process of putting together, a business and a platform and an investor group, it's too late. So I'm working on putting that together now with people who share my philosophy and will be ready to move at the time, when the time is right.
Yeah, that's a smart way to approach it. You spoke a little bit a few minutes ago about some of your criteria, or looking at an undervalued asset as far as making the investment. Do you have any other like specific criteria or just examples of a criteria that you look at? Like maybe it's occupancy or maybe it's a local market.
Well, I focus on the Southeast, and the reason I focus on the Southeast is because I like the demographics down there. You've had basically 7 decades of uninterrupted movement into the region that shows no signs of abating. It's driven by by factors like the weather, things that are really like not going to change, right? Unless something really dramatic happens. So, I like markets that are growing. I like markets that are preferably growing faster than the national average. I like markets that have a certain size population, like, at least 250,000 or so people in the MSA, just to make sure it's big enough and diverse enough and liquid enough. What else? I like markets that are, you get a little more granular, right? I stay away from markets that are like too heavily dependent on a single industry or a single employer. I like when you get a little more granular, I like good school districts. I think all things being equal, good school districts where there's some kind of barrier to entry, where the tenants that you get who want to be in those good school districts that they can afford to buy in are really your best tenants. No matter where they fall on the economic spectrum, they tend to be the ones who are the most diligent and motivated. They're going to bend over backwards to pay the rent to make sure their kids can stay in the school. That's why they're there. Right. So it's a better group of tenants, a higher quality group of tenants, so no matter what their income is. And I like anchors, what I call, things that never go away, things that are unaffected by the economy. So state capitals can be good anchors. State capitals never going anywhere. Ports, airports, inland ports, really big universities like the major main campus of a big state university can be a great anchor. Or depending on the MSA, even a smaller college, if it's big enough, like a big college and a small MSA can be a really good anchor, things like that. So that's the kind of stuff I look for when I'm looking for like where to look for property.
I love that. Yeah.
Yeah, that's a great example. Jim and I were talking, or we went to a meeting a couple of weeks ago, and that was one of the topics about Charlotte versus other cities in the region. And it's, even Charlotte versus Raleigh, like the airport we have, you can't just go duplicate that in another city. That's something that's here and it's ironclad. You literally can't go duplicate that in Raleigh. So that's great.
Yeah, I mean, you guys are in Charlotte, so like the inland port down in the upstate in South Carolina, right, in Spartanburg, that can't you can't pick it up and move it, right?
Right.
Like you can't move an inland port. And then what happens when you have some transshipment port like that, where you're like moving stuff from rail to truck, it starts to attract a lot of other distribution businesses around it that need to do the same thing. And then there's the whole spin-off effect from that. So, those things are great long-term anchors. They are, since you're talking about business, if there is a recession, then obviously like employment will kind of ebb and flow a little bit. But like you're never going to be in a situation like you could be with, say, like a military base where like the government could decide to shut the military base down anytime, right? No matter what they say, no matter what they say about, and you hear it all the time, like, blah, 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 military base, like it's going to be there forever because some congressman, blah, 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 like that. I would not rely on that stuff. I avoid those kinds of markets. I don't consider military bases anchors because they could just be shut down at a moment's notice. But stuff like an inland port is a major infrastructure that's not going anywhere.
Yeah, I think that's something a lot of people should pay attention to because there's, on paper, great deals in like more rural markets. And sometimes some people try to say, oh, it's 2 hours from the major city. And I don't know, for me, that's not close enough. And it sounds like for you, it's probably not close. What is like your proximity that you look for where it's like within that anchor?
Well, I mean, so it's got to be within the MSA for one thing. So a lot of these smaller rural areas won't actually be within the MSA, right? So, they won't be near the anchor. Like, if you want to talk about like an anchor, like say an inland port, I mean, you really have to be pretty close to it, right? It's not like, 50 miles away is really, by the time you get there, like the economic effect is not going to be felt. People aren't going to commute that far, right? You have to think about the fact that people want to be close to where they work, right? So if you're trying to get like the inland port and the spin-off from that, like you're talking about a fairly small radius, right? But almost every rural area in the United States is in decline population-wise, right? I mean, people are moving. They have been, again, like people have been moving from rural areas to the cities for 100 years or more, and there's no signs of that abating, right? So the population is just shrinking. Even in a place like South Carolina that has really strong population growth, the rural counties of South Carolina are shrinking, right? Because everyone's moving to the cities. So I stay away from small towns and rural areas for that reason. Now, it's not to say that you could never make money in a situation like that, but I think to make money in those situations, you have to go in at the absolute bottom of the market, and you have to be like taking deals off people who are distressed. You know what I mean? Like you've got to be picking up these assets for pennies on the dollar to build in a big margin of safety so that you're still going to make money. And then you want to like offload it when there's a big market frenzy like right now and just get out while getting out is good. But buying, I've seen this a lot of times where people come to me and said, "Oh, I've got this deal. What do you think?" And it's like, they're like, "Well, I should buy it because it's an 8 cap." And I'm like, "Yeah, but this is a tiny town and the population is declining and it's dependent on one chicken plant for everybody's employment. And an 8 cap is really expensive for this deal, right? You should be buying this deal for like a 15 cap, right?" But
yeah,
you're smiling because I think you know something. You've heard of a deal like this before, right?
Well, but that we agree with that, and it's just I've got family that's in the chicken business in South Carolina, so yeah, that
in a small town
that hits home, and you're absolutely right, absolutely right.
Maybe the deal I'm talking about was in that town. I can't remember. I definitely saw a deal recently where they were touting the chicken plant as the employer, and I just thought, it just set off an alarm bell for me. Not that there's any. I mean, I think people will probably eat chicken forever, but just don't want to be dependent on one employer, right?
You're 100% right. I mean, there's several counties in South Carolina where that is the biggest employer, and then I find it funny too, because I do a fair bit of new construction, and anytime I'm doing a new construction deal, some of the rural banks will look at the proximity to the chicken plants or the chicken growers and be like, we don't want to finance a house that's too close to a chicken area because of the smell, the EPA, the whole deal. So it's funny. You've hit home for sure.
Can you talk a little bit about how you establish your investment criteria? Once you have a location, what other criteria have you established, and how did you get to choosing that as, like, for example, you mentioned community size of 100 to, I think, 125 units. What does that look like, and how did you kind of back into those?
Yeah, it doesn't have to be exactly in that niche, but it's really more like, really once you get up to about 125 units, then you start getting some economies of scale with the staffing. Right? Even 100 is a little difficult. 100 is kind of a weird size, but you want it to be bigger because you definitely see your per unit operating costs dropping because that labor cost is such a big piece of your budget. Mm-hmm. So, 125 units or so, at that point you're getting really good property management. You're getting them at a good fee. There's just a lot of economies that you have once you get to a property that size, right? And not to say I won't do smaller ones. I have done smaller ones, but I like to do them if they're close to something else I've already got, so I can manage it together and try to get some efficiency that way. Because otherwise, you just, I could just see it across the portfolio. Like it's just much cheaper to operate a property that's, 130 units than to operate one that's 100 units.
Yeah.
Right? So
absolutely.
That's one thing. But also you don't want to get too big, because then you start competing with the institutional buyers who, are looking for, for 5% returns a year, and they're willing to bid up to that point. So you want to kind of stay below that level. Don't get up past 10 million or so in deal size, because then you're really getting into competing against people who have a very different expectation.
Yeah. Is there any other criteria you have other than like unit size and cap rate that you look at, like maybe year built, or like I don't do flat roofs or something like that?
I don't care about flat roofs particularly. I've done flat roof properties, have been fine. In terms of like year build, that's something that I've changed my perspective on at first I was looking at like the 1970s product, and all the stuff that we bought was 1970s stuff. And the issue with that is that those properties are just really getting old, right? And the systems are starting to fail. And, we definitely ran into some problems with stuff underground, that's in bad shape, and it just comes to bite you. So when I start buying again, and now, what I'm looking for is really more recent product. Kind of like the sweet spot is probably your late 90s, early 2000s construction that's ready for a refresh, right? Something that hasn't, it's new enough that it's pretty code up to date, and the systems are still in pretty good shape. You're not really seeing the breakdown of the systems yet. You've got another 10, 20 years to go on those things, but you've got, maybe just sort of, you've got outdated, amenity packages, and you've got, outdated look to the apartment, stuff like that. That's kind of like the sweet spot.
Yeah, where the color scheme is 1990s, and you can bring it to 2019 colors and throw granite in and call it a Class B or Class A apartment.
Yeah, exactly. I mean, it is sort of age-wise a Class B. You probably can't get it to a Class A unless you're willing to spend a lot of money on it. But, where you can do, you're just kind of going to refresh it, bring it up to what people want right now. And, without the systems falling apart. I mean, look, you can take a 70s building and do that too, right? You can go and upgrade the apartments so they look more modern without even spending a tremendous amount of money. But the problem really is not so much the cost of upgrading as the stuff
cosmetic.
It's the stuff that's coming up that you don't expect, or that you maybe you expected it but just hoped it wouldn't come up. So that's kind of really gonna whack your bottom line. So I think the 70s stuff, there's a lot of cosmetic upgrades being done to 70s product now. And I think what's coming up for that asset class is, either the complete obsolescence of the properties or them needing real major upgrades where people are going in and really like replacing the plumbing and replacing, upgrading the electric and like really doing massive, upgrades to the properties to modernize them. Because otherwise I don't think they're going to be able to compete as well.
You mentioned looking for opportunities to like refresh the appearance of a community. Are there any other value adds that you look for that you've kind of been surprised at in your experience?
I'll tell you one thing that I was really surprised at about how well it did was painting the doors on a property.
Really?
I was really surprised. Yeah. Like we had on the biggest property we owned, we came in, and that was kind of like the heaviest value add that we did. We did a lot of cosmetic stuff to the property, a lot of landscaping, a lot of things like that, just to kind of refresh it. We did the rental office, did a lot of work to the pool, did a lot of landscaping. But then we had some extra money in the budget, and the property manager said, well, we think it's a good idea if you repaint the doors. And it was something that I hadn't even thought of, but they said, look, the doors are it's like 1970s colors. They're dark brown. They're, and I hadn't really, the whole property was like 1970s style. So I didn't really think much about the doors. I thought like, you can't really change the look of this property. Well, I was really surprised. We went and we painted them some kind of much more modern, like sort of grayish color, and it really looked great. It really looked nice. And I think it really added value to the property when you drove the property, it had just a very different look to it.
Really?
Yeah. Another thing that I've learned is about rebranding the properties. I used to just buy the properties and just continue to operate them as they were. But I really think there's a lot of value, and this is a very cheap thing to do, is to rename the property and get new signage. It's a really low-hanging fruit value add. And what it does is it instantly, people notice it, right? And they're driving past every day, and all of a sudden one day they see this property's got a new name and it's got this really nice new sign outside. And that signals to them like, hey, something new is happening here. Maybe I'm going to take a look at this apartment that I thought wasn't such a great place. And it's great if you have negative reviews of the building go away.
Yeah, this is brand new.
The old building name there's no such thing, right? So that's really low hanging fruit that people can use to. I would say, like, if you have zero budget to do any rehabbing or very little budget, and there's only one thing to do, rename the and put a new sign up is probably the best bang you're going to get for your buck.
What could you tell us about, you obviously research a lot of different areas in the Southeast, I'm assuming. Can you enlighten us a little bit on what value you've got in a team and who you work with and why you work with them and how important they are to you? Because, I mean, you're one guy and I know you can do a lot, but you certainly need some help, I'm sure, from time to time.
Yeah, I mean, not only will I tell you sort of who I work with, but I'll tell you who I need to be working with in the future too, as I kind of change things. So the team, the most important piece of your team, I really think, is going to be your local property management. Especially if you're from outside the market, but you've got to have those boots on the ground. You've got to have somebody who has real local market intelligence, and also who just really understands the cost structure of running a property in that market. Right. So before you talk to anybody else, like before you ever even talk to a broker in a market, you should be talking with property managers and learning the market from them, and then picking somebody that you're going to work with. And you can use them for just all kinds of stuff, just super helpful. But you can run your underwriting by them to make sure that your cost structure makes sense. You can double check if you've done your market research on rents. You can double check it with them. They'll probably just give you what they have. They should be following the market themselves in terms of rents and rent comps. So that's really critical to have on the ground. Probably the most critical. Then other team members, not so critical to have on the ground in the area per se, but obviously you want to have your legal team that's licensed in the state, whatever state you're operating in. Helps to have your accountant there. Not absolutely necessary, but helps to have an accountant who's local. And then you start getting, you need to have contractors that you can turn to for advice about, what's going to cost you to fix up this property. Oftentimes, the management companies will have that expertise too, so you can lean on them. But it's good to have people that you can rely on for that sort of advice. I'd say that's sort of the basic team. There are other sort of team members that you need to get stuff closed, but in terms of getting property and finding property and getting property and running it, that's sort of your essential team, I'd say.
Can you give us maybe a little more on your property manager? Do you vet certain property managers just with experiences you've had in the past, just to make sure that their views are as realistic or conservative as yours?
So property managers are looking at things from a little different perspective, right? Because good property managers have in mind making money for their owners, but that's not really what they do, right? What they're really doing is they're trying to keep a property full and they're trying to keep it in rentable condition, right? So you can't rely on them. You've got to be the one who's kind of focused on the bottom line, right? I mean, they should be looking at it, but it's really your job to do that, not theirs. And you have to be on top of them about that. But in terms of like vetting a company, it's really important. There's a number of things that I've learned through bad experiences that you need to, that you need
best ones.
to be. They're the only ones you learn from. You don't learn from the good experiences. You only learn from the bad ones, right? So one of the things that I've learned is you really need to have somebody who's local to the market, right? Like not somebody who's nearby the market or who's trying to break into the market or anything else, or who you get along with, who's not there. You really need to have a local property manager who has a long history in the market and really knows the market well. And the reason for that, there are a number of reasons. Obviously, the market intelligence part, but there's also the market reputation piece, right? It's very hard for people from outside the market to hire the right people, right? People aren't going to take a risk. Like the best on-site managers are not going to take a risk on some property company they've never heard of before, So and the vendors, right? The vendors are not going to trust this property management company they haven't heard of before. So you want to have someone who's local and really good, has a good reputation in the market for those reasons. Then you want to vet them according to a number of, at a very high level. You want to vet them according to a number of criteria. The first being real experience with exactly the kind of property that you're buying, right? So it can't just be that they have experience in the market. If they're a company that basically manages Class A, they take over new build properties and they're in lease up, and they're just doing Class A and they're dealing with the most affluent tenants and the best amenities and all that sort of stuff. And, that's a very different proposition than a C-class property, right? It's a very different management skill set. Same thing, in the other direction, someone who's used to subsidized housing, It's a very, very different skill set than managing a C-class market rate property, right? So you want to make sure that that company has the right expertise. And then you also further want to make sure that the people that they staff on the property have that expertise too, right? And kind of everyone who's in the chain of command over your property, so the on-site manager, whoever that on-site manager is reporting to as an asset manager, you want to make sure that those people really understand this asset class. Because if they don't, it can really get sideways on you very fast. And that's actually happened to me. So this is really critically important. You have to make sure that they're going to, not only do they have the expertise, that they're going to put the right people on your property, and you have to possibly get in their face a little bit about it if you think that things are not going the right way, like if they're not putting the right people on the property.
Yeah. And is an example of that probably like they're trying to run it as a Class A and it's never meant to be a Class A. They should be running it as a Class C?
Well, I mean, I guess that's an example, although it's hard to imagine that they would try to run a Class C property as a Class A. Like it just wouldn't work. It's a totally different like tenant base that you're talking about. It's more like the problem I ran into specifically was I had an on-site manager staffed on a market rate C property whose background was in subsidized housing. And subsidized housing, you don't have to market, right? They have such long waiting lists to get into subsidized housing that there's no marketing needed. But a C-class market rate property needs marketing. And if you don't market the property, your occupancy is going to drop, right? So we had a really bad vacancy problem in a strong market, which shouldn't happen. And it was all because the property manager never did any marketing, so that's an issue. Or just things like that. They have to be more aggressive. I mean, I could see like not so much the issue being that like a Class A manager would try to run a C-class property like it's a Class A property, but there are just problems that they wouldn't know how to deal with necessarily. Right? You're going to have a lot more collections issues at a C-class property. You have to chase people more for rent.
Yeah,
stuff like that. That if you're used to Class A, you're used to people just probably their rent checks are coming in from. They've got it set on autopilot from their bank account, and they're never writing a check, right? Whereas when you've got a Class C property, you've got people who have to go and get money orders from the bank, from the money order place to pay their rent, and they may not have the money, or they're very busy and can't get to the money order place, or what have you. There's a whole host of reasons why that you might have to chase them. And if you're used to not chasing them and you don't, and you just think, oh, they're just going to come in and pay, then you can wind up with a serious collections problem very fast. You've also got, a C-class property is just going to have more problems. You're just going to have, it's a different tenant base. So you've got, issues that are associated with people who, let's just say there are issues that are going to appear on the property that you're probably not going to have on a Class A property where you've got a bunch of, like lawyers and consultants and doctors and stuff living, right? So.
Yeah, that's great. Can you talk a little bit about where you found like the best ways to find deals so far, and like what you're focusing on? Are most of them coming from broker relationships, or are you going after off-market properties, or?
So for me, the sweet spot has always been the off-market properties I get from brokers, right? So it's like the pocket listings, or the deals that the brokers put together. I mean, good brokers will put together deals themselves. But they'll go and they'll say, I've got a client who's looking for a property, and they'll just pick up the phone and start calling owners and say, will you sell, and put a deal together themselves. So I've had good luck with those. I haven't done mailings. I haven't tried to do the direct to owner outreach. I know people can do really well with deals that way. I know people are successful, but the amount of effort it takes to do that is very, very high. And I also think that it's probably easier to do for smaller properties where the owners are less sophisticated.
Absolutely.
But when you're talking about 150 unit properties, even if it's a mom and pop operator, there's sophisticated people who are running these properties, and they know what their properties are worth, right? Maybe you get lucky and somebody just died and their kids have the building and they don't know what to do with it, and they get a letter and they're like, okay, I'll sell. But other than that, for the most part, when you're dealing with the larger properties, you're not dealing with people who don't know what they've got and are willing to just sell it because they got an offer. And even if they get distressed, chances are they're going to go to a broker and say, go find me a buyer, preferably go find me 10 buyers who are going to bid against each other on the property. So I haven't gone that way. What I found to be more effective is once you close a deal in a market, then brokers start bringing you stuff that's off market.
Yeah, absolutely. We actually had a commercial broker on last week on the podcast, and he shared a tip for how to get pocket listings. And it was as simple as staying in contact and just asking if he has anything that, might be of interest. Is there anything that you've done or you've seen that has helped you get access to pocket listings, which are, I don't know if hard is the right word, but not everyone gets them, obviously.
Closing deals is the best way to get pocket listings, right? I mean, if you want to just be really blunt about it, that's the best way. But listen, there is, even if you haven't closed deals, you can get pocket listings. But just like that broker said, it's all about building a relationship with the broker. And what I always tell people is, if you're looking at a market, and let's say you've decided to invest in a particular market, like you've done all your research, it meets all the criteria, you've been down there, you've looked at it, you're like, okay, this is the place I want to be. The last person you should call is the broker, right? You should be putting kind of, unbeknownst to the broker, weaving a web around them so that by the time you reach out to them, they have no choice but to call you back. They have no choice but to answer. And the way that you do that is by getting to know the people who know the broker before you get to know the broker, and then getting warm introductions from those people. So, the good property managers will know all the top brokers in the area, right? The lawyers will know them, and the accountants maybe will know them, right? The managers are probably going to be your best source for getting to the brokers, right? So why reach out cold to a broker, right? You're not ready to close a deal anyway at that point. But why are you going to waste their time by just asking them to send you deals that you can't even close because you don't even have an infrastructure yet? Build yourself that infrastructure so that the minute you get a deal, you can hop on it, right? And use the people who are part of that team to get you to the top brokers. And if you do it that way, by the time you get to that broker, you're gonna have all the reputation of the lawyer and the property manager and all those people that you're working with. That's all stuck on you now, right? So when you go to the broker, they're just going to assume that you can close deals because you came through these other people that they know and trust. They're not going to ask you for proof of funds. They're not going to ask, they're not going to ask you to prove yourself as legit. And they're going to start showing you deals right away. Now, obviously you better close them or you can burn that relationship very fast, but you're not going to have that problem of the broker trying to keep you at arm's length because you came in the right way. You came in a way that built legitimacy for yourself rather than, just calling them up cold. So they're like, who are you? Why should I talk to you?
Yeah, I love that. And that way you have all your ducks in a row so you can close the deal. And you're using, if you're using all the top people in town, the brokers are immediately going to assume, okay, you clearly know what you're doing. And they're going to take you a lot more seriously than if you just called them from LoopNet and said, hey, I want deals, multifamily, office space, houses. It's much more professional and they take you more seriously that way.
Yeah.
Yeah, absolutely. You have to do it that way.
Yeah, I think kind of we've been talking about all this together, but yet being able to execute on that due diligence or already having a lot of due diligence done for that area so that when you do talk to the broker, you know that you want to move forward or don't want to move forward. So like you mentioned, you're not burning bridges when you get something under contract or tell them you're going to buy it and then you don't. Having that in place beforehand, I think that's really important.
Yeah, and it's good to have real criteria in place also, because then when brokers send you stuff that you're not interested in, you can have an intelligent conversation with them that actually builds the relationship as you're rejecting the deal, right? So you can have a conversation with them about, hey, thanks for showing me this deal, but we're really looking for this other thing, and this is why the deal doesn't work for me. Or in fact, brokers are simultaneously doing two things. One is, they're pushing deals out there and they're just trying to make as much money as they possibly can, right? And they're hoping that somebody's going to overpay for the property. But the good brokers also really understand the market and they understand the investor mindset. So when you go back to them and say, this deal this deal doesn't work for me because it's really overpriced or whatever, the good brokers are going to say, yeah, I know. But, and you're not going to burn the relationship with them, but you're just going to show them that you're not a buyer who's willing to overpay for this asset, right? So you can help build that long-term relationship. And eventually the assets are going to be priced better. And you want to have that relationship already there and have them know who you are when it comes time. When it starts getting harder for them to sell deals, you want them coming to you in that situation, right? So you can manage the relationship in a way that strengthens the relationship, even when you're turning deals down.
Yeah.
But communication is the key. Like, don't just like ignore them, right? Like, look at the deal, underwrite it, decide why it doesn't work for you, and then tell them, like, this is why it doesn't work for me.
So, like, along those lines, when you get a deal that comes across your desk, what are some of the things you do initially to vet it against your criteria? Like, are you doing full underwriting, like pro forma on it, or what are you doing initially?
So, well, it depends on where the deal is. I mean, if it's a place I've never heard of, like literally the first thing I'll do is I'll get on Wikipedia and look at what this town is or whatever, and frankly, like, see if the population is growing or shrinking, right? So if the population is shrinking, I just don't even want to look any further, right? Or if the population is too small. But if it's a deal in a market that I know, I'm just like reading the package, like trying to look and see whether this is going to be even worth my going forward with or not before I even get into underwriting. Like, so what part of town is it in? Like, that sort of stuff, right? Then if I get to the underwriting stage, then usually you can underwrite a deal in like an hour, right? It doesn't take you, as long as you have the right material.
Right.
If you got the operating statements and you got a rent roll, then you can take a crack at underwriting and see what it's worth to you. And then, if what it's worth to you is anything close to what you think is being asked for it, then move forward. But I think what happens to me more often than not is I'll come up with what I think it's worth to me, and like I just know that it's not even going to be close to what they want to get for it, and probably can get for it. So
yeah. And when you get the broker's packet and like they've got their financial projections, is there anything in there that you very commonly see as you need to double check or run your own numbers on that part of the performance?
I ignore their numbers completely. I don't think they have any value at all. I think you just look at the operating statement, but there is one thing that I look at, and I'll tell you what it is. So if you know how property taxes are calculated in that area, you can look at their pro forma, like the tax number that they have in their pro forma, and back into what they think they want to get for the property. So because they have to come up with a number for that in their pro forma. Right? If they're brokers who are like lazy or whatever, they'll just put in the old tax numbers into the pro forma. But if they're good brokers and they know, like, okay, they've got to come up with a real tax number in the pro forma, and the tax number is going to be based on, taxes are going to be reassessed at sale, right?
Mm-hmm. Yeah.
They've got to calculate it based on a sale price. So even though they've got like this unpriced offering and it's like to be determined by the market, they always have a number in mind that they're looking for. And you can back into that number if you know the formula for calculating property taxes in that area. So you just take that tax number and you back into the number that they're looking for. And that can tell you whether like this is something you want to bother going for or not, if it's in range of what you think the property is worth or not.
I love that. I've never heard of doing it that way.
Yeah, that can help and hurt you. If you buy an undervalued, like in South Carolina is a good example. Some of the counties there, they'll reassess at sale, as you mentioned.
Yep.
If you buy it at a third of the current, appraised value, that's a good help. But you don't want to tell anybody about that. You let them keep that tax number on there until you close.
Oh yeah, no, they're gonna use whatever number, whatever you close at is the number they're going to calculate your new taxes at, right? So if it's, if you're buying at anything above the current tax appraised value, then you're going to have a tax increase. I think a lot of people get themselves into trouble because they don't understand how the taxes are calculated. So they use the seller's numbers. Another number that gets people in trouble all the time is insurance. Because they think they're going to get the same insurance rate as the seller, which never happens. Usually they don't have the same labor number as the seller. Usually your cost structure is higher than the seller in most cases. And I think a lot of people get themselves sideways because of that, because they just assume they can use the seller's numbers.
Yeah. On a large community of, let's say, like 100 units, what do you typically budget for property management?
So that's going to be a negotiation with the manager, right? I've been able to get 4% management fees even on the first deal because I've said like, hey, we're going to be buying a lot in this market, so give us a good rate now and you'll get our future business. So you can do that. I mean, for 100 units, you should be able to get 4%, probably not more than 5%, I think, on a 100 unit deal. When you get bigger, you should be getting less. And if you're up at 200, should be getting like 3%.
Yeah.
But I think I would seek out 4% at the max for 100 units. I think that you can achieve that.
Do you ever see a future where you might self-manage versus using a third-party manager?
I think the circumstances under which that might happen would be if I ever grew the business big enough that I started getting into like big pools of institutional capital where they want you to be self-managing, right? So, but short of that, I mean, managing property management is a whole different business than asset management. It's a whole different skill set. So I know lots of people sort of have this idea, and I did too when I started, that like, oh, we'll eventually do self-management. And I've been talked out of that by people who have tried it. And, you know, I think the only way to make it work is like to go buy an existing management company. I think it'd be very difficult to like start a property management company from scratch without having experienced yourself in that business. Because asset management and property management are like totally different skill sets.
Right. You brought it up, you know, working or potentially, or, you know, a future where you might work with institutional capital. What would that look like to you if you did want to do something like that?
Just the ease of raising money, you know, like just the having, you know, capital sources that are very deep pocketed. You know, if you can get into a situation where they really trust you and they've worked with you before and basically going to fund everything that you do because you're a proven operator, it's a great situation to be in, right? Without having to go through the difficult process of raising, you know, millions of dollars in $50,000 chunks, right? It's just that's a difficult process. So it's always attractive to get into that institutional space. But then, of course, you know, there's other things that come with it. You know, they can be a lot more demanding. They want a different kind of product, you know, so there's trade-offs that come with that too. But just certainly the ease of raising capital would be attractive.
Yeah, that's kind of what I meant. What would be attractive, and I guess what wouldn't be so attractive, and I guess it'd be answering to a lot of different things that you don't normally have to do.
I think the level of reporting is probably much stricter. You know, you have to have a lot more controls in place and probably a bigger staff and stuff like that. That institutionals going to, you know, I'm to be honest with you, I'm not totally familiar with what they want because I haven't dealt with them directly yet. But I think it's going to be a lot more sort of, they want to see a lot more infrastructure than your typical syndicator has got.
Right.
Yeah, I would think the accounting part of it would be a lot more than what most people would be used to, as far as, you know, properly audited financials on a monthly.
Yeah, audited financials, and they're going to want to have like everything mark to market and like all kinds of stuff that as a syndicator you're just not typically doing. And probably, you know, things like succession plans and key managements, and you know, they're the ones who are going to be very like your LPs and syndications ought to be asking the question, what happens if you get hit by a bus?
Right.
But I think a lot of them don't. The institutional players will definitely ask that question and want you to have, you know, preferably a big enough team that if no one of you is not expendable, right? You know, they want you to all be expendable, basically. So
Right.
And this can probably be an entire podcast series, but can you talk a little bit about how you're financing deals and raising capital through what sounds like syndications?
Yeah, well, so the equity piece is all, you know, syndicated, right? It's all from an investor group that I've assembled over time. In terms of, you know, the debt financing, so when I got started, it was a little bit different in the environment now. It's much harder for new investors to get agency debt, even if you had like professional property management on site. It still didn't satisfy the experience requirements. My understanding is that's changed, but we started out. The only thing that was available to us was CMBS debt, so the commercial mortgage-backed securities debt, which the advantage of it was, you could lock in very low rates for 10 years. The terms are very attractive, but the servicing is just really onerous, and there's no room for any kind of adjustments. And it's the people who are servicing these loans are very constrained, and they have no discretion, basically, right? So it's very, very onerous to deal with CMBS, and there's a lot of penalties that come with prepayment and stuff like that. So it's really not, to my mind, really attractive debt. It's if you can't get anything else, then you go with CMBS. But so we did CMBS debt. I've done it both directly to a lender and through a mortgage broker. I find doing things through a mortgage broker to be much better, just worth every penny that you pay in fees to the mortgage broker to have them take all that work off your shoulders and also help you get a better deal in the first place.
Yeah.
And go to bat. And they have negotiating leverage with lenders that you don't have as like a relatively new syndicator or a small syndicator. They've got relationships with the people who were writing the loans, and they can push back for you, and you just can't do that on your own. So when I first started, I was like, I don't want to pay these guys a fee. I'm going to just do this myself. But I learned quickly that was very penny wise and pound foolish. Yeah. Going through the brokers is it's totally worth it.
Is there any broker that you'd like to share?
Yeah, no, I work with guys down in your neck of the woods they're now called Bellwether Capital, and I work with a guy named Will Oldham at Bellwether, who's awesome. I highly recommend that you reach out to Will if you are looking for debt. They'll only do $1 million or more of debt. They don't do smaller deals, but if you're up there over that $1 million mark, they've been terrific, and their execution department is also just excellent. They really do a good job with execution.
Fantastic. And lastly, what are some of the common mistakes you see newer investors when they're trying to purchase their first multifamily community?
Gosh, where do you start? Well, it really depends. Is there any particular category you're looking for? There's lots of different people make mistakes in their underwriting. They make mistakes in how they try to get deals. Was there anything specific that you guys were looking for?
You mentioned falling too hard and believing too much of the current owner's financials and not doing your own. So that'd be one that I'm sure is common. Yeah, I guess anything specific to, and we've talked a lot about population growth and getting granular on it. So I don't know, anything like, hey, maybe you should have looked at, maybe it wasn't sub-metered. Something along those lines.
It's really not so much that they're, whether it's sub-metered or not. All these things are just a number that goes into your underwriting that you have to understand and then bid accordingly, right? Yeah. So it's not the issue. I think is more not knowing how to underwrite, or getting too aggressive on your underwriting in order to make the deal work. Not double checking it with other people to make sure that you're really on track with it, with say your property manager or what have you. I think believing what's in the OM that you get from a broker is a big problem, relying on those numbers rather than on the actuals. You really have to underwrite based on a combination of the actuals and then what your cost structure is going to be based on your property management and all that sort of thing. So I think too much optimism is probably the biggest problem for a new investor. And certainly I did that myself, and I think people just, they think it's going to be easy. They think they're going to make a lot of money very quickly. They think they're not aware of the traps that they can fall into. So I think those are really, over-optimism is probably the biggest rookie mistake of all.
Yeah. That's what's going through my head too, is it's an easy time to get excited about the investment and you want to be optimistic about it. But I think probably just having a good network of folks you can, have shoot holes in it is probably very important.
Absolutely.
Yeah. I think you should be, if you're new, you should be extra cautious because you're just not, you don't know what you don't know yet. Right. And you need somebody out there who's going to kind of look at what you're doing and point some holes in it. I have to say though, like I've been in this situation. Like new investors need to avoid this problem I'm about to talk about. I've had people come to me and say, "Hey, Jonathan, would you look at my underwriting?" And I'll look at the underwriting and I'll poke holes in it, and they just get angry with me, right? I mean, I've just probably saved them millions of dollars, but overbidding on something. But their response is to get angry with me, and the reason is because they came into this with, like, they've convinced themselves they found a deal, they're really happy, they think they're going to make a lot of money, and then you point out stuff that they didn't know, right? They had no way of knowing, and I don't know if they feel embarrassed or if they're just pissed because you just burst their bubble, but they need to come into it. If you're going to go approach somebody for help, you really need to go into it with some humility, because chances are when you're starting out, you haven't found a deal, right? If you're new, maybe you got lucky, but I'm going to tell you, like, especially in this market, 99 times out of 100, you don't have a deal. You don't have the deal you think you've got, and you need to be really careful. So when you're talking to mentors, like, go in with a bit of humility and expect to learn something. Don't expect to have them just endorse your fantasy.
Yeah, absolutely. And then before we wrap up, we want to jump into the fire round, where we just do quick, short questions. There's 4 of them. First one is, what's your favorite way to source deals?
Brokers.
What's your favorite market to invest in?
I'd say Greenville, South Carolina.
Okay. Is there any particular reason?
Yeah, it's growing really fast. It's got a really diverse economy. It's got more. It's a bit more affluent than some other parts of the area, and I like it. And they have good steaks there.
Perfect. What's the best piece of advice you've ever received?
Oh my God, I've received a lot of good advice, but nothing's coming to mind right now.
You're good. We'll add it to the show notes. What's the book you most often give to others? So this one is a little bit out of the blue. I guess I don't give it so much, but I recommend this a lot. Is the War of Art by Stephen Pressfield. This is not a business book per se, but it is just a great book especially if you're an entrepreneur, and especially if you're trying to do things on your own, like, to help you just sit down and get stuff done. Right? It's just brilliant for that, about why you just need to sit down and just do it. Yeah, I'll definitely check that out. That sounds great.
And then before we wrap up, is there anything you want to educate the folks listening about your new Launchpad?
Oh yeah, well, thanks for giving me the chance to do that. So as you guys have alluded, I've got a program I run called Multifamily Launchpad. The whole idea behind this program is to try to bring really high quality real estate education to people at a much lower price than you get from kind of like your typical real estate guru. So it's a monthly membership. You can be in for as long as you want or as little as you want, and it's a very low price point. So if you want to check it out and get on my mailing list, the best way to do that is to go to multifamilylaunchpad.org. Not .com. So multifamilylaunchpad.org/ultimate-checklist, and you can download an ultimate checklist of doing your syndication deals, and you'll get on my mailing list, and you can learn all about the Launchpad program from me that way.
Perfect. And how else can our listeners find more about you and follow what you're doing?
The other best place is to join my Facebook group, which is called Multifamily Investment Community. That's free, but it is closed, so you have to answer a couple of questions to get in, primarily not to spam the group. So as long as you agree to not spam the group, you're in. And look forward to it's a great way to get to know me and to just be part of a big community of people who are doing this business.
Perfect. Well, Jonathan, we really enjoyed it. We'll add everything in the show notes so people can get to those website URLs really easily, as well as the book you recommended. But thanks for your time.
Yeah, thanks so much.
Yeah, thank you for having me on the show. I had a good time.
All right. Take care, Jonathan.
Take care. Bye-bye.
All right, bye-bye. Thanks for joining us for another episode of Who Knows Real Estate. Be sure to subscribe to the podcast, leave a review, and check out our show notes for the guest contact info as well as ours. Be sure to look for our next episode. Thanks.